I think when you look at the very long-term trend of the US dollar and the change in sentiment generally in the United States with respect to interest rates, we could well see a continued and quite prolonged dollar weakness. I think in the short term that's going to be very positive for risk assets, as you point out, very positive for emerging markets, very positive for commodity plays. And that's where we would be looking to shift our portfolios. In the longer term context, we've been in a very long boom for the US dollar. It's been going on since 2012, and commodity weakness, frankly, has been the corollary to that. So I would see us moving into a period where we do see a reversal there. It's a pattern that is going to be part of a long-term shift. The outlook for the Western economies is pretty horrible.
Pretty horrible, do you think? Because what I heard from Jay Powell was saying, actually, the U.S. data is still so strong. It wasn't so much the horrible picture they're worried about today. It is the expectation, something we've seen playing out in markets about what could happen. But you're saying it already is horrible?
I think he's deflecting a lot of the attention from the mixed messages that are coming out of the U.S. economy to the global scenario, where we've got a lot of uncertainty. We've got tremendous weakness in the European Union. We've got, obviously, risks associated with Brexit, weakness around Italian banks. We've got a slowdown in China precipitated by this trade war. All of these things are only going to compound the worrying signs of the change in sentiment with respect to rising interest rates. You know, if the US economy was booming, rates would be on an upward trend. Now, on the long term, they probably are. But in the short term, we've had a change of that rhetoric.
Let's talk about two of the big factors that the market has factored in here, saying, okay, perhaps the Fed can't have 2 rate hikes this year. I mean, one of those will be on the U.S.-China trade front and the spillover effects there. The other one seems to be the market turbulence. I mean, Jay Powell has told us he's listening to the markets, but both of those things have really improved since 2019 kicked off. So if those are the two big catalysts for what the market is predicting in the way of a Powell put, if those risks start to fade, then shouldn't the odds of a Powell put fade too?
I don't think that those risks have gone away by any means. I mean, we're into a period when traditionally institutionals come in and allocate money, and you invariably do have a bit of a rally. We saw that in last year. We saw a very strong first part of the year, and then we saw this big sell-off. We saw this reversal in sentiment. The big question is, I think, relates to valuations.
Right.
Are people now revisiting the valuations that the US equity market is trading on relative to other places that they can deploy capital, the emerging markets, for example? And have we had this phenomenal shift of assets in a rather indiscriminate way into US equities during this risk-off period, when we've had, obviously, a period when people have been just moving money into the US equity market because there's nowhere else to go?
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.